Welcome to this explainer. Okay, let's just dive right in, shall we? Today we're taking a remarkably consistent community bank, Stock Yards Bancorp, ticker SYBT, and putting it through the ultimate investment gauntlet. We're going to extract the hard data from their latest proxy statements, earnings reports, and analyst projections, and run it all through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before finally subjecting it to our own rigorous quantitative models. If you want to know exactly what this stock is worth, you are absolutely in the right place.
Here is our roadmap for today. We've got company snapshot, the Buffett lens, the Lynch lens, the Graham lens, DCF and quant models, and finally our synthesis and final verdict. Let's get to it.
All right, Section 1, Company Snapshot.
So Stock Yards is a $2 billion market cap bank operating across Kentucky, Indiana, and Ohio. Currently trading right around $67.65. But here's the thing. They aren't just your run-of-the-mill traditional lender. No way. They boast this massive wealth management and trust arm with over $7.64 billion in assets under management. To put that into perspective, that ranks them among the top 150 trust companies in the whole country by revenue, giving them a massive competitive differentiator in the community banking space.
And their operational excellence? Absolutely undeniable. Get this, they've grown earnings in 31 of the last 35 years. They've hit record net income in 29 of the last 32 years, including an estimated record of $4.75 per diluted share in 2025. I mean, it basically took the Great Recession and a global pandemic to even put a dent in their growth. That's some serious consistency.
Moving on to Section 2, the Buffett lens.
You know, Warren Buffett absolutely loves financial institutions that are easy to understand, have a wide economic moat, and crank out highly consistent earnings, while Stock Yards passes with flying colors. That top 150 wealth management arm we just talked about, that is a fantastic fee income moat. Plus, their 14% return on average equity, which is just a fancy way of measuring how efficiently they generate profit from shareholder money, puts them in the 82nd percentile of their peers. Incredible. Add in their super manageable debt of about $326.8 million against over $9.4 billion in assets, and yeah, Buffett is definitely nodding his head.
But here's the absolute crucial part, calculating what Buffett calls owner earnings. Now in banking, free cash flow is notoriously tricky to pin down, so standard practice is to just use net income as a proxy. Using their record 2025 net income of $140.2 million and applying a reasonable multiple with a margin of safety, we calculate an intrinsic value right around $71 per share. With the stock currently trading at $67.65, it's very likely the Oracle of Omaha himself would be a buyer here.
Next up, Section 3, the Lynch lens.
Peter Lynch's first step is always categorization. In Stock Yards, it's a classic stalwart, a steady, consistent earner that offers a nice cushion during recessions. They've got a rock-solid balance sheet with a tangible book value, which is essentially their liquidation value, of $30.41 per share. Plus, they pay a really reliable $1.26 per share dividend. But what Lynch would absolutely lose his mind over is that 7.1% insider ownership. That is incredibly high for a publicly traded bank of this size. It literally means management's money is right there in the trenches alongside the shareholders.
Now, Lynch is famous for the PEG ratio. That's price to earnings divided by the earnings growth rate. Right now, Stock Yards trades at a PE of about 14.24. When you factor in their historical and projected revenue growth pushing near 15% recently, their PEG ratio comes out to roughly 0.95. Listen, for a stalwart category stock, a PEG ratio under 1.0 is literally the holy grail. Lynch would view this as being priced perfectly.
All right, let's put it to the real test. Section 4, the Graham lens. Benjamin Graham, the absolute father of value investing, demands an immense margin of safety, period. Let's run his checklist. Stock Yards passes the size test with its $2 billion market cap, and it easily passes earnings stability and dividend record. Its PE of 14.24 is safely under Graham's strict limit of 15. But here's where we hit a snag. It fails the price-to-tangible book test. Graham wants a ratio under 1.5, and Stock Yards is sitting pretty high at a premium 2.29 times tangible book.
So let's actually quantify that failure using Graham's famous intrinsic value formula. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. And in case you're wondering, that 22.5 is just his maximum PE of 15 multiplied by his maximum price to book of 1.5.
When we actually plug in the SYBT numbers, we get an intrinsic value of $63.19. Trading at $67.65 today, Graham wouldn't even touch it. It's a fantastic bank, sure, but Graham was notoriously stubborn. If it doesn't offer a deep, contrarian margin of safety, it is a hard pass for him.
Moving past the legends, let's get into the hard math. Section 5, DCF and quant models. To build our base case discounted cash flow model, we're using some very clear assumptions based on the analyst data in our sources. Step 1. We use net income as our cash flow proxy and grow it by the 8.8% broader industry growth rate projected by analysts. Step 2. We calculate a terminal value assuming a highly conservative 2% perpetual growth rate, basically just matching inflation. And finally, Step 3. We discount it all back to today using a 10% cost of equity or WACC. That's essentially the minimum return an investor expects from a regional bank. Looking at our sensitivity table, our base case, that's a 10% discount rate and 2% terminal growth, lands right in the middle at a $71.18 fair value. Now, if you believe they can grow a little faster, say 2.5% perpetually, that value jumps up to $75.60. But sticking to our base assumption, the math says $71.18. Now, to make sure our DCF isn't just some crazy anomaly, we layered in two alternative models. First, using a dividend discount model based on their 1.26 dividend, we get a value of $68.04. Then, looking at comparable PE multiples, if we apply their historical 14x multiple to the $5.10 EPS that analysts project for 2026, we get $71.40. So everything is pointing in the exact same general direction.
All right, time to bring it all together. Section 6, Synthesis and Final Verdict. Just look at how incredibly tight this clustering is. Across 5 drastically different evaluation methods, we are seeing fair values land right between $68 and $71.40. Buffett, Lynch, our DCF, and the alternative models, they all agree the stock is either fairly valued or slightly undervalued right now at $67.65. Literally, the only outlier is Benjamin Graham, who stubbornly demands a price near $63 just to establish his deep value margin of safety.
So what does this all mean? Well, the crucial point really comes down to weighing the bank's operational quality against its valuation. The strengths are absolutely undeniable. 32 years of nearly uninterrupted record earnings, a fantastic 14% ROE, and a highly lucrative wealth management moat that their peers just don't have. But the risk? You are definitely paying a premium for that quality. At 2.29 times tangible book value, there just isn't a ton of room for error if the interest rate environment suddenly turns hostile.
Which leads us to our final verdict. At $67.65, Stock Yards Bancorp is a solid hold. It's fairly valued for its incredibly high quality. However, if market volatility somehow pushes this stock down to Graham's intrinsic value target of $63.00, wow, that would trigger a massive buy signal across literally every single framework we tested today.
So I'm going to leave you with this to chew on. As an investor, do you pay a fair price today for 32 years of bulletproof consistency? Or do you wait patiently on the sidelines, hoping for Benjamin Graham's strict margin of safety to kick in? That's the ultimate question you have to answer. Thank you so much for joining me for this explainer, and keep learning.